Okay, recording is started. All right. All right. Let's just take a quick look at Nifty. All right. That's what we see on Nifty. This is the 125-minute chart. So, what do you see in this chart? What inference do you derive from this chart? Reverse at 8:30. Why do you say so? Yeah. So now, now, yeah. So it's coming up from the daily demand zone. The confirmation is done, and now if you see this, was this trending down? Welcome back, everyone. Can you please confirm if you can hear my voice and see my screen? All right, sorry. So now the power has actually come back. That's why the it took time for us to switch over. Now it's all okay. All right, so let's just quickly take a look at Nifty and then get back to our lessons. All right, so Nifty has been continuously falling, and then we saw the bend happening, a drop, base, and a rally, and it's moving out. So remember, uh, all these are going to be normal speed bumps here. They are not going to push the price down unless something drastically changes globally. Okay, otherwise I do expect Nifty to at least go to 10,988. Let's 11,000 could be easily another 200 points is what we'll see. Today Nifty will probably be within 10,800 because of the expiry. So probably option writers might want to keep Nifty below 10,800 and maybe about 10,750. So now you'll probably see this is what is happening. All right. But now avoid short trades so far. Weekly supply zone. Where is a weekly supply zone formed? Where do you see a weekly supply, Divya? Yes, confirmation long can be taken, Sony. Where do you see weekly? So the first target would be at least up to this point. That is this 10,900. Then the second will be 11,000. So the intermediate trend could shift to up. So tomorrow, so today's price action is also giving. Yesterday I told you, right? And the daily chart, if we see a follow through today, okay, if we see a follow through today, that will confirm that the change in trend right now. Now on this daily chart, what do you see here? Do you see any great supply zone? Yeah. So in all likelihood, the prices will reach up to 11,000 odd levels. A lot of stocks are moving from the higher time frame demand zones as well, isn't it? Yeah. So your intermediate focus should be on the long side right now, not on the short side. Shorts only when you reach this area. Okay. All right. So that should be good. So this is what we see on the. Let's see what do we see on the 75-minute chart. So this is what we see on the 75-minute chart. Nicely moving up. So today it will be like a little bit subdued now, basically for expiry. All right. Let's go ahead now. Here, odds and answers. The structure tells you that. Any other question? See, Bhavya and Sushila typing. Let me just wait for their questions. अरे हो गया ना निफ्टी. Okay. Sushila, it's right now that the trend intermediate trend is shifting to the upside. So you should focus on longs and pullbacks. Shorts only at around 11,000 levels, not before that. Daily supply zone or daily demand zone? Omkar. I didn't get your. I mean, supply zone is far right now. All right. Till then, anybody has any questions on the long call strategy rules? All right. Perfect. So let's go to the next strategy, which is Omkar. Are you done? Otherwise, I'm going to start with the strategies. Okay. So 15th Feb. Yeah, yeah. So that time it was ready. Now it is not because when you took that trade on 15th Feb, right, Omkar, the trend was still down. So the trade was valid. Now any shot that you take will be counter. Yeah, that's okay. That's it. The supply wasn't great, but then it had not yet hit the daily supply zone, demand zone, right? So when the trend is down, even the worst supply zone will hold. The trend will change only at the higher time frame demand zone. So once it hits the higher time frame demand zones, your shorts start becoming very aggressive. And which time frame trend, and also higher time frame trend is sideways. Yeah, so Nifty is sideways on monthly and weekly, and now probably it is going to remain is change to sideways even on the daily. Okay, let's go back to our second strategy, which is long put. So what does a long put give you guys? Right to sell. So right to sell. So long put is a bearish strategy. Absolutely correct. So it's a bearish strategy which gives you the right to sell. And where do you execute this? At an area of supply. Absolutely correct. Okay. So the application of this strategy is the script is trading in is in a downtrend and trading in a supply zone. This again is not recommended unless you have 90 days out expiry. Okay, unless you have 90 days out expiry, you will not trade this. Again, this is done when volatility is in section 1. And why do we buy options in section 1? Because they are cheaper and we expect the volatility to come back to the mean. So potential benefit from implied volatility revert into the mean after an extreme drop. Correct. And in periods of calm, market participants will often sell options below what they are actually worth. And that is to your advantage. The characteristics of this is again limited risk because you are buying option, the risk is limited. Reward is unlimited. Break even is strike price minus premium. What is the break even for call option? Strike price plus premium. And in case of put option, it is strike price minus premium. Now, why is delta negative here? Negatively correlated, absolutely. And bearish position also has negative delta positions. Why is theta negative here? Because theta is negative for option buyer. Theta is negative for option buyer. And vega is high and positive. Perfect. Okay. This is how the graph looks like for a long put. As the stock goes up, you will have limited loss, and the loss is limited to the amount of premium that you paid. Okay. Is this slide clear, everyone? Perfect. Let's go to the next slide now. Again, everything is the same. The trade action is instead of demand zone, once it hits the supply, buy and at or above the supply, a put option, isn't it? Buy a put option at or above supply. And at or above what? Supply means at or above the distal line. The strike selection should be at or above the distal line. So trade action buy and at the money or slightly in the money put option, which is going to be anchor unit. Parameters again, expiry minimum 90 days, isn't it? Minimum 90 days to expiry since we are buying an option, and minimum delta is minus 0.25 and at the money will make it minus 0.5. at or above the distal line or the stop loss line of the supply zone. That's the strike selection, Bhavya. Strike selection at or above the supply distal line of the supply zone being used for entry. Now, once the stock hits your entry line, that's when you buy the put option. Now, if it hits your supply, if it hits your stop loss, exit. If it hits your target, then again exit. Roll over if expiry is less than 60 days. Now, you all know why we have to roll over with 60 days remaining. Who gets active? Theta. All right. And evolve if implied order moves to a different section. So if once the stock starts moving in your favor and IV changes from section 1 to section 2, you will have to evolve your position to section 2 strategy. Okay. When implied volatility moves to section 2, and Rameshji, there is a nice lesson in XLTs on this. When you go through that, evolution process will be very, very clear to you. Yes, Chandrasekhar ji, the strategy will change at section 2. Amit Kumar, your question is invalid. That's why I did not answer it. Did we speak about section 4 or section 5 strategies so far? No. We only know that in section 5 we are supposed to be a seller of option, right? And not a buyer of option. So the answer is no. You cannot buy a call option. Now, this is the strategy is complete. Let's take an example and see. So this is the supply zone starting at 5. Okay, let me zoom this. This is the supply zone starting at 5805.75 with a stop above at 5863.40 and your target at 5528. And the current stock price is trading at 5667. So above 5863, what is the next strike? Look at the option chain. And let's say here it is 5900. Okay, so once the stock hits 5805.75, at that point just go ahead and buy the 5900 put option because volatility is in section 1. All right, everyone. And the only thing that I do to make sure is that I have a delta of minimum 0.25 here. Since it's an at the money option, the delta will be 0.48. Theta and Vega, whatever values are available, you have to take it. So look at the value of theta. Only 2 paise loss with 1 day passing. But with a 1% increase in implied volatility, you're going to add 11.5 rupees to your option value. Isn't that a good value? Nearly 10% rise in the option value. This is the RBI rate. So NAC actually uses, I think, 9% or 10%. 10% interest rate is applied while computing implied volatility. Okay. Yes, you will buy put at section 1. This is a section 1 strategy. Pudupet. Why confusion? What is your confusion? You have to do this at supply zone, not at demand zone. Yeah, so you're buying a put option, right? You're buying a put option. That's what you're doing. Just that it's a bearish strategy. See, the difference in options and futures is you can buy options and be in bearish or bullish. Whereas in case of stocks or futures, if you want to do bullish, you have to buy the future. If you want to do a bearish strategy, you have to sell the future. That's it. But here you no, call is at demand, put is at supply. When your stock comes to your supply zone, the volatility section could be anything, right? 1, 2, 3, 4, 5. Similarly, the stock, when it comes to your demand zone, the volatility section could be anything, 1, 2, 3, 4, 5. So when the stock hits your demand zone, you go and check what is my volatility section. Okay, it is in 1. That means I'm supposed to be a call buyer. No, it's in section 2. Oh, it's in section 2. So I'm supposed to be into a bull call spread. Rameshji, who told you that demand zone, supply zone, the IV should be compulsory section 1? You cannot decide. No. If it's a question, no. It could be any section. Okay. Is that clear now, Rameshji? When, Abrar, when the stock hits your demand or the stock hits your supply, the volatility section is not dependent on the demand zone, supply zone. It is dependent on people's expectation. No, in the IV tool, it gets automatically updated. Okay. So anybody has any issues with long call, long put? I'm yet to tell you, Sureshji. Yeah, so you might have to replot your demand zone, supply zone, Puru. So you can go through the evolution session in XLT. There is a lesson session on position evolution. You can go through that and everything will be clear. So you check IV twice. One is at the planning stage, the other one is just before the execution. So if you let me finish, I will tell you all these things tomorrow. This is not a topic for today. You're preempting questions. Okay, let's just go through this terminology summary. Underlying asset with OTA core strategy. On top of that, you apply your OTA options. Long call is the right to buy the stock. Long put is the right to sell the stock. Right? Long options are debit strategies. The risk is limited and the reward is unlimited, and you can exercise your right. Short call is the obligation to sell the stock. Short put is the obligation to buy the stock. Since you're selling options, you're receiving premium, and since you're receiving premium, this is a credit strategy. Because it's a credit strategy and the maximum profit is the premium amount that you receive, the risk is unlimited and the reward is limited to the amount of premium that you received, and you run the risk of getting assigned. Option contract specification consists of term which has different expiries, front, next, and far. Each term will have different strike prices, in the money, at the money, out of the money. The strike rule selection rule is choose strikes at or above the distal line of the supply zone, or at or below the distal line of the demand zone. With each term and strike price, look for the implied volatility versus historical volatility condition, which will tell you the market condition, and that will decide your option strategy depending on the market condition. Each term and strike price is going to have a premium. That premium consists of intrinsic value and time value. Intrinsic value is affected only by the underlying price movement. Time value, the parameters that affect time value can be studied using delta, theta, or gamma, rho, and vega as the Greeks. The premium is what you buy to open an options trade and sell to close that options trade, or sell to open a credit trade and buy it back to close that credit trade. Call options have positive deltas, put options have negative deltas because of the correlation. When you're buyer of options, the theta is always negative and vega is positive. When you're short options, delta is negative del for a short call and delta is positive for a short put. Remember, bullish positions will always have positive delta position, bearish positions will always have negative delta positions. Theta is positive when you are a seller of option, and vega is negative because increase in implied volatility is going to hurt your position. Is the summary clear? All right, let's go ahead now. I'll do it next time again. There is another slide coming in deeper. That time I'll do it again. Now let's go ahead with the. So we completed long call and long put. Any questions on these strategies? Okay. Now let's go to the next strategy. That is, these are the section 5 strategies. Section 5 means what is the how is the inflation level in section 5? High. Since it is high, will you be buyer of an option or seller of an option? Seller of an option. So the application is the script is in an uptrend and trading in a demand zone. But when the script is trading in the demand zone, now the IV is actually in section 5 and not in section 1. Okay. Implied volatility is trading in section 1. Sorry, section 5. So potential benefit from implied volatility reverting back to the mean after an extreme rise while receiving theta. As time passes, is theta going to pay you? If you're a seller of an option? Perfect. In periods of panic, okay, this is in periods of panic, market participants often buy options for more than what they are worth, and that is to your advantage. So people will simply buy. So the stock is coming to the demand zone. There is panic set in everywhere. Everybody thinks that it's going to go down. So everybody will rush to buy put option. Now, सच्ची सच्ची बोलो ये कल परसों तक जब मार्केट गिर रहा था पुट ऑप्शंस किसने बाय किया पिछले 2 दिन में कितने का पुट बाय किया दिव्या 10,800 ka put you bought. At what price? What do you want to hedge, Anand? Square root of in loss. Yeah, that's because you bought a put option when you're sitting in a demand zone. That's a mistake. And volatility will definitely be more than section 3 or 4, I guess. Nifty volatility. Bought at 242. All right. Now, what is the price? And what expiry did you choose? The Feb end. Okay, so you lost 40 rupees. March. Okay, no problem. Long positions in your underlying in stocks or in futures? Okay, no problem. You can hedge the stocks. No problem with that. Now, since this is a debit credit strategy, the risk is going to be unlimited. The reward is going to be limited to the amount of premium that you have paid. And break even is going to be strike price minus premium for call options. This is how the short put graph looks like. Okay, as the stock starts moving up in your favor, the reward is limited to the amount of premium that you received. And as it starts going against you, that is, if the stock starts continuing downwards, you're going to lose unlimited if you do not use your stop loss. All right, is that clear? So what you do is the same thing. Here you had bought call option, right, when it was in section 1, isn't it? Yes, Sushila. So instead of that call of buying that call option, you are going to sell the put option now. Yeah, so it would have been a counter trend trade, but then it should have been a great demand zone. If all the time frames are down, all the time frames are showing downtrend, right? It doesn't make sense to sell puts because that will be very, very dangerous. Okay, so you sell a put. So once the stock hits the demand zone entry point, you sell a put option at or below the demand zone. So when you sell the put option at or below the demand zone, is the put option going to be at the money, in the money, out of the money? Hey Chandra, how can it be in the money? It's at the money, which is going to be slightly out of the money. It's not in the money. Put option. Remember, it's a put option. The call option will be in the money. Correct? So the strike selection is simple, at or below the demand zone, distal line of the demand zone to select. So it is at the money, which is going to be slightly out of the money. So what happens is once the stock starts moving up, the decay is going to be faster, isn't it? Because it's an out of the money option. Or even if the stock keeps hovering in the demand zone, time as time passes, theta will kill the premium, and that's how you benefit from this trade. Is that clear? So section 5, you just cannot buy options. You have to only sell options in section 5. Again, close if the target or stop is met based on script price. Close if target or stop is met on the script price, or close if the short unit, that is minus P, is trading at 2.5. Now I want you to make a change here. Instead of making it 2.5, make it the unit is trading for 10% or less of the premium received. Alright, so if you collected 200 rupees premium, the moment the premium value now becomes 20 rupees, you have to exit. So you have collected 180 rupees, now 20 rupees, leave it and get out of the trade. Remember, you will never wait for the option to become completely zero. Alright? And evolve if implied volatility moves to a different volatility section. That is, implied volatility moves to a section 4. Your question is invalid, Amit. You are trying to find an answer from me. What can I do? In section 5, you're supposed to sell a put option at demand zone. That's it. That's your answer. You're asking me, what if IV is in zone 4 or 5 but demand zone is near? If you can't buy call, how should we interpret such setup? What is this setup that we are talking about now, Amit? Forget Nifty. I am telling you, you listen to this. Do not look at your trade or what you are trying to get. Is the stock coming into demand zone here? Is the stock coming into demand zone? Here, is it hitting the demand zone? I'm not sure why Amit isn't answering. You guys ask questions and disappear. Yes. And what is the implied volatility condition? Section 4, 5, 1, 2, 3. What is the implied volatility condition? No, this I'm talking about the current example that I'm giving you. Is this a section 5 strategy? Short put. If section 5 at demand zone you're supposed to short put, do you know the answer to your question? That's it. If the stock is coming into demand zone and we are trading in section 5, the only strategy that you're going to do is sell a put option. You really cannot buy anything. Because if you buy, that means you're surely donating the money. When you're selling options, right, Kapil, what do you sell? Smoke or real value? Yes, futures you can buy. Who's stopping you to buy futures? No, what is stopping you to sell a put option, Amit? Are you apprehensive about selling options? Alright, then go and buy futures. This is a psychology issue and you have to work on it. Alright? As a trader, you can't be scared of selling options. Murugan, I gave you that example, right? If you sold an option and you collected 100 rupees premium, what is 10% of 100 rupees? 10 rupees. So once the stock starts working in your favor and when you have sold an option, is your put going to reduce in value? The moment the put value becomes 10 square, take your 90 rupees and enjoy your profits. Got it? 10% of whatever, when you sell, you receive some premium. Whatever premium you receive, 10% of that, when it is remaining, you exit. You will never wait for zero and never wait for options to square off till expiry. Remember that. Okay, if that is, if you think this is invalid, listen to what I did when I was not an options, when I had not taken education of options, but I used to only sell options. Continuously, I started selling options and making 10% return on my capital every month. For 8 to 9 months, I made approximately 10% on my trading capital. That time, I had kept trading capital for options as 10 lakhs. So, on an average, I used to make 1 lakh rupees a month. For 9 to 10 months, continuously, I started making this only by selling options. Okay, that time I had no idea about volatility and anything. The only thing I used to look at is supply zone है उसके ऊपर बेच दो closer to expiry. And the mistake I used to make is I used to wait for this premium to become zero. Okay, one single trade took away half of the profits that I had earned in 9 months. A Honda Amaze went away. Karnataka Bank, absolutely correct. So that's the reason we do not wait for it to become zero. Yes. All right. So is short put clear to everyone? Demand zone, stop loss. So what happened was the I had sold that option for 1.8 rupees. The stock came all the way to 20 30 पैसे. I thought अरे और 20 पैसे 10 पैसे पे मैंने ऑर्डर लगाया, वो वहां से जो घूमा, because the stock jumped 20%. सोचने का टाइम भी नहीं देता वो. And I had to, something that I sold for 1.85, I had to square off at 18 rupees. बड़े बड़े पापड़ बेले. यस, ह्यूज क्वांटिटी. हम तो शेयर है ना, क्वांटिटी कम नहीं करते. Yeah, 20. See that rule, Arun, you decide. You know yourself very well. So you have to wait. So Pudupet, when it comes to section 3, right, it is already lost value and it must be trading at about 20% of the total value. It's your risk taking capacity. So in non-directional strategies like iron butterfly, I in fact get out at 50-60% of the credit received. That's still a lot of money. 10% thing, Kapil, is if you receive, when you sell a put option, do you receive premium? And that is the maximum profit that you can make. Let's say you sold a put option and received 100 rupees as credit. Now this credit is still not yours till you square off your position, isn't it? Whatever is there is notional. Now when do you square off? Do you square off when the premium becomes zero? Yes, you can, Ravindra. It's up to you, I said. The decision to square off at 50, 60, 70, 80, 90 is up to you based on your psychology. So tomorrow I'll tell you how to do this. Yeah, right now only monthly. So Kapil, once you receive that 100 rupees and as the stock starts moving in your favor and the option becomes worth 10 rupees, which is 10% of the total credit that you had received, you get out of the options trade. Yeah, I know, Ashish. So this is something that only with experience you will overcome. Only with experience you can overcome. Everybody says इतना क्यों छोड़ दूं मैं, वो भी लेके निकल जाता हूँ. कम पैसा नहीं है. But this is human psychology. You will not see the 70 rupees that you have received, but you will look at the 30 rupees that is remaining. And in anticipation of making that 30 rupees, you will lose out the 70 rupees also that you have made. That's human psychology issue. Umkar, what do you mean? I know IV behaves like pendulum, but theoretically. Kapil, when we sell options, we only sell out of the money. We want to sell only time value. We don't want to sell an option which has intrinsic value. Yes, Omkar, that is possible. Just take a look at the IV tool and you will get your answer, Omkar. What comes in few days, Ramesh ji? Hey, how will the credit comes in few days? I mean, the credit you will receive today, but that will actually be yours only when you square off. So till the trade is working in your favor, you'll have to wait for it. Remember, option trading is swing trading. So you'll have to wait for some time. All right. So is the short put clear to everyone? Come on, guys. We have a lot of strategies to cover. All right. Let's go to the next one, which is so this is the example of short put. So the same. So the same. Here we had in the first example when volatility was in section 1, we had bought the 100 call option, right? Now instead of since that time volatility was in section 1, now volatility is in section 5 when it comes to this demand zone. So what you're supposed to do is instead of buying the call option, you'll go and sell the put option because options are inflated. Sell the 100 put option once it reaches 107.20. You will receive, let's say, a credit of 6 rupees with a delta of 0.33. Our delta value should be minimum how much? Plus 2.25. And whatever theta and vega you get from the strategy, you just have to accept it. So whenever you do the proper strike selection, right, the delta will always be managed to 0.25 or above. You place the order, Bhavya. The moment stock hits 107.20, that time you go and sell the 100 put option at your entry line. Long call again the same thing when it hits 107.20, and if it is trading in section 1, then instead of selling the put, you will do a long call. The same 100 call option, same strike price. The 100 call option, if it is going to be in the money, the 100 put option will be out of the money. Remember that. Now, this is the same strategy. Correct. So when you're selling options, stay within 60 days. So when I say stay within 60 days, doesn't mean you go to next month. You first try to see whether the current month offers me good reward to risk. Yes, then I will use the current month. If the current month doesn't offer me, then I'll go for the next month. Correct, Bhavya. At demand zone, if the IV is section 1, you buy a call option. If it is section 5, you sell a put option. No, this reward I'll teach you tomorrow, not today. Now this is short call. This is done in supply. Okay, it's a credit strategy and is a bearish strategy. Application script is in a downtrend and trading in a supply zone. IV is in section 5, which means options are inflated. So implied order implications are potential benefit from implied volatility reverting to the mean after an extreme rise up to section 5 while receiving theta. While receiving theta means time decay. In periods of panic, so in periods of panic, which is in section 5, market participants often buy options for more than what they are worth, and that is to your advantage. Like for example, uh, Amit was saying that, can I buy in section 4 or 5 a call option? So you will find many of these people doing it. Most of the people doing this only, because most of the novice options traders, right? They have no idea about writing options. They have no idea about implied volatility conditions. They have no idea about inflation, deflation. The only thing they know is I can buy a call option or buy a put option because that is cheaper than doing futures or the stock trade. That's how their mentality is. Was this your mentality at certain point, some point in time, all of you? Because it is cheap, we want to buy it. Because it costs me less, it is going to we have to buy it. That's so, even I have been a donor for a certain amount of time when I was thinking like this, like you only, and you are still the same. Yeah, so if someone tells you, sir, call option buy kar lo, bas khatam. Yeah, and plus you buy out of the money also. अरे और सस्ता है यार वो, आउट ऑफ द मनी है, मुझे 3 रुपए देना पड़ रहा है उसके लिए. You add the money in the money, 20-25 रुपया है. Oh, so the Indore and Bhopal advisors, they are primarily taken by these operators and big guys, so that you generate liquidity, right? So if they have to sell the option, they need option buyers, isn't it? Otherwise, how will their trade get executed? Yeah, so they will tell you, sir, इतना ही risk है, आपको tension नहीं है, ले लो, because they want to sell it to you. Yeah. Most of the people are, because everybody thinks stock market में पैसा बनता है, advisory service ले लो, and all these advisory services are illegal, by the way. Okay. Now, this is a bearish strategy which you will execute in supply zone. Risk is unlimited. Why is risk unlimited here? अरे सुशील इतना नेगेटिव नहीं सोचने का, ढूंढने से तो भगवान भी मिलता है. And good things always take time. Remember, good things never happen in a hurry. Because you have sold options and you have collected premium, the reward is limited to the amount of premium that you have received, and the risk is unlimited. Correct. Break even, since it's a call option, break even is strike price plus premium. And it is irrespective whether you are selling or buying options. Remember, in the long call also break even is strike price plus premium. In the short call also the break even is strike price plus premium. Remember, long or short is your decision. Whereas strike price plus premium is the inherent characteristics of a call option. Correct. This is how the graph looks like. As the stock drops, you will have limited reward up to the amount of premium that you have paid, and if the stock goes against you, you're going to have unlimited losses, and that is going to be a break even, strike price plus premium. Now in the long put option above supply, this was the plus P, right?